Every single thing, from the deck of an aircraft carrier to a railing in a new building, is going to be built by an American company.
It's really important to get the vaccine out there as quickly as possible. There's an urgency here, and that's what the waiver is about. It's not changing the basic framework.
We've been clear today, we have not changed the stock quantitative easing that we're doing this year. So what we've changed is the pace at which we achieve that stop.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning and welcome to Bloomberg Surveillance Early Edition on this Friday, the 7th of May. I'm Francine Lacqua in London, and here's what's coming up on today's program. Rising risk appetite becomes a concern for the U.S. Federal Reserve. The governor, Lael Brainard, says more granular disclosure may be necessary after the Archegos debacle. Bloomberg learns that President Biden is likely to keep up the Trump-era limits on Chinese investments. And Cathie Wood's ARK Innovation ETF slides another 3% as inflation fears take hold of investors. Coinbase plunges to its lowest level since last month's IPO. So the Federal Reserve has warned over asset prices in its semi-annual financial stability report. It says risk appetite, well, for risk across a variety of asset markets, is stretching valuations and creating vulnerabilities. Lael Brainard, who heads the board's Financial Stability Committee, said, quote, the Archegos event illustrates the limited visibility into hedge fund exposures and that as a result, the level of risk may be missed by regulators. Now let's get more on all of this on the Financial Stability Report with our Danny Berger. Danny, what seems to be the consequence, and good morning, what seems to be the consequence of the Fed actually bringing this warning over asset prices?
Yeah, it's really interesting talking about Archegos and, again, sort of the froth in the market. And look, I think that market participants were already very surprised at the end of last month when Powell talked about there being signs of froth in the market. And so they'll probably be even more surprised to read the stability report and see them talk about meme stocks. Francine, as far as I'm aware, we've never had the Fed saying anything about memes, and they talked about it not once but 3 times. And so it's really talking about the risks. It mentions IPOs, SPACs, and meme stocks. And it's interesting, it also comes on the day, of course, this report came out after the close, but IPOs actually saw a big drop yesterday. So it's not necessarily that investors are wringing this excess out of the financial markets. Perhaps it's going into other places like Bitcoin, but still, it's enough for the Fed to be raising a warning. Now, folks over at the Cato Institute, like George Selgin, would say, look, it's kind of contradictory that the Fed is talking about this when the consequences of their easing of low rates is that we see excessive risk-taking.
Danny, speaking of froth, we've also seen the popular ARK fund continue to stack up losses.
Yeah, definitely. And again, it kind of goes with that trade yesterday of the IPOs, the really high flyers starting to fall. So we have Cathie Wood's fund here, the ARK Innovation funds in the white. It had done really good, starting to fall. But strangely enough, real yields are also starting to fall. You'd think that lower picture would help bring growth appetite back in. And Francine, that's where we get this picture that stocks and bonds are not telling us the same story at the moment. Not only are these big tech names, the big perhaps frothy stocks selling off, but we're also getting a move into value. So I want to show you banking versus the yield curve over the past week, because banking stocks actually have done well, but at the same time, we're getting a flattening in the yield curve. So who's right in this circumstances? People like to say the bond market is smarter. Perhaps they think the Fed is going to stay on hold. But again, stock markets showing a different signal at the moment, Francine.
Yeah, Danny, thank you so much. Something to wade into. Danny Berger there with some of the market movements. Now, joining us is James Pomeroy, HSBC Global Economist. James, I have questions about valuations. I have questions about what Danny was just talking about, a lot of money chasing yields across the board. And then, of course, it's also jobs in the U.S. Do you worry about, if not asset bubbles, froth in the market right now?
I think it's interesting. We're in a situation where the global economy, the US economy in particular, is likely to grow very quickly this year. Interest rates are low, and that is a favorable environment for risk assets. And it is just the world we're in. And you're seeing this across a whole range of risk assets. It's not just financial assets. You're seeing this in house prices. You're seeing this obviously in crypto markets as well. You're seeing this in sort of a whole range of ways where people are clearly looking for a little bit extra return than the very, very low interest rates and they'd get in their bank accounts. And it is an encouraging economic environment that is backstopping that, not just lower interest rates.
But is there a danger to that, James? So as long as things go up, that's fine. But at some point, if there's normalization in interest rates or we even talk about tapering, what happens in the markets? Are we going to see a temper tantrum?
You could, of course. But the big difference is you've got, at the same time, you could see slightly higher interest rates and people could start to rethink some of these investments. But at the same time, as I say, you have got this big economic reopening and this strong economic story. So you could see certain parts of financial markets fare slightly worse, and that could be part of the reopening story. We had a year where people have been spending a lot of money on goods, a lot of money on digital consumption, using Facebook and using Netflix and using Spotify much more. And if we all start going back out to smaller cafes and restaurants, then that changing shape of the economic recovery could play into financial markets as well. So it could spook investors, but I think it's part of the story, but there's a much bigger story going on here, which is sort of supportive of demand and supportive of risky assets, which is this big economic boom that we're seeing.
Yeah. Is the boom at risk of actually leading to an overheated economy? So we have the jobs report today in the US. What are you expecting?
So we're looking for just shy of 1 million jobs, and that seems to be pretty in line with what the market's saying. But I think the really interesting thing to watch here is what happens with the recreation and leisure sector. And then that's the part of the economy where jobs have been most beaten up, unsurprisingly, given the lockdowns that we've seen. And those number of jobs are still about 20% lower than they were pre-pandemic. So there's a lot of gap to be closed in. But that's also the sector that you probably see the biggest sort of pickup as the economy reopens. So I think it's a really good indicator of how quickly businesses are trying to bring people back, how quickly we're seeing spending pick up in those sectors. And I think actually the jobs number itself is going to be very interesting, but some of the sort of niche details underneath it could tell us a lot, not just about how the US economy did in April, but also setting us up for May, June and beyond.
Do you believe inflation will be transitory? We were speaking to, or Matt Miller had a conversation, for example, with the new Siemens chief executive who, because of commodity prices, is going to pass on price hikes. I mean, these are price hikes that will probably never be reversed.
It's possible. I mean, what's been really interesting in the past couple of months is if you look at some of the PMI numbers, if you look at those input price indices, particularly in the US, they're incredibly strong. On the manufacturing and on the services side. So it suggests that businesses are feeling these huge cost increases. And it's not just base effects, because they're increasing every single month. We're seeing these higher costs coming through, and it's these shipping costs, it's commodity prices, all of these things which are hanging around. Now, as you say, the big question is how much of that is passed on. And at the moment, the things like the output price indices are not picking up anywhere near as much. And in certain sectors, we will see some pretty clear inflationary pressures in the course of 2021. It's those sectors that have had beaten up supply, where there's not as many flights, or there's not as many Cornish cottages here in the UK, or nice hotels in certain parts of the US where people want to go and travel domestically. You're going to see these big pick up in inflation. You're seeing it. The best example for me here is garden furniture in the UK. Huge demand, huge lack of supply, huge inflation. But across the board, the broader set of goods inflation we think does fade in the second half of the year, because a lot of these effects that are pushing up goods prices are relatively short term. And if they do fade, you should see that goods price inflation fade a little bit in the second half of the year. That going against that service price story probably keeps inflation higher than it had been pre-pandemic, but probably not high enough, sort of around the 2% mark, to mean that central banks, including the Fed, are not feeling real pressure to keep hiking. So what we think we do see is this pickup in inflation is relatively transitory, but inflation does stay slightly higher than previously in the second half of the year.
James, thanks so much. James Pomeroy there of HSBC stays with us. Now, coming up, the UK economic recovery gathers pace, and the Bank of England discloses its bond buying program. Up next, the Governor, Andrew Bailey, tells us that a major shock would have to happen for the central bank to reverse course. This is Bloomberg.
We would have to have some, severe disappointment in terms of the outcome. So an obvious case in point, obviously, unfortunately, sadly, would be the return of COVID in a big way, which caused further economic dislocation. Now, we're not forecasting that at the moment. We don't see the evidence of that, but it would have to be something that caused...
Like a shock?
That's, yes, a negative shock of some sort.
Well, that was the Bank of England Governor Andrew Bailey on why he would need to see some kind of negative shock before considering expanding QE next year. Now, James Pomeroy of HSBC is still with us. James, I had a conversation with Governor Bailey yesterday, and I tried to understand from him whether he'd be one of the first central banks to actually taper into next year or after beyond, even before the Bank of Canada or not. Does it make a difference of who goes first?
Probably not really. I think what's most interesting is the rough direction of which central banks are sort of positioning themselves on that sort of dove-hawk spectrum. And the Bank of England is clearly pushing itself towards the more hawkish end of that, not pushing back on market pricing of some tightening, talking about some tapering to come, and all of that together does put the Bank of England at the more hawkish end. And it's sort of, there's a whole load of reasons why they can be hawkish, and it's some of this economic recovery we're seeing. Some of it is the incredibly good vaccine rollout here as well. So there's room for optimism for the UK, and that fits in nicely into this relatively hawkish Bank of England. The exact timing is not too important. It's more about sort of where central banks are positioning themselves on that spectrum.
The political, I guess, ramifications of an independent Scotland and things like that will have a huge impact on the economy of this country. Is this one of the bigger shocks, actually, for the Bank of England, I guess, away from COVID-19, which has been pretty, well telegraphed?
Yeah, most definitely. I mean, any sort of political uncertainty, as we saw around the Brexit sort of story over the past 5 years, can weigh on the economic recovery. And it's that uncertainty that hurts investment, it hurts trade, it hurts all of those things, including sort of employment as well. And so, yes, the UK is in this slightly odd situation at the moment where the consumer recovery is likely to be pretty strong, but the risks in terms of investment and uncertainty are relatively high, both in terms of the spillovers from Brexit, but also any uncertainty around Scottish independence could add to that too. So it's not sort of a clear cut sort of this is how much it would take off growth, etc. But it's that weighing uncertainty that we think holds back investment partly this year anyway because of Brexit. But any additional uncertainty wouldn't do the UK recovery a lot of favours.
James, what does the UK economy actually look like in 2-3 years?
Hopefully, it's grown quite nicely. I mean, the UK has been a consumer recovery as a consumer economy for quite some time, and the consumer recovery we're seeing at the moment is hopefully going to continue to create jobs and to grow back a service sector. And clearly, the government here wants to try and sort of upgrade a lot of our industry, want to be much more tech focused, want to create jobs in those sectors. And if that can be done, the UK can do relatively well in the coming years. But the big challenge is going to be, can we sort of keep generating jobs at the same pace that we had done previously? Can we keep investment coming into the UK? And it's a much more uncertain outlook for the UK than probably many other economies in the world at the moment. So hopefully it's one that has diversified a little bit, has got a lot more jobs in high-tech services, and it's one where jobs are back and the economy is growing nicely. But it is likely to be an economy where we're not expecting this as rapid, complete rebound from the pandemic as we are in the US, just simply because of some of those risks that are out there in terms of investment.
Sometimes, James, when you look at how markets are priced, it seems that we forget that there are many variants of COVID, certainly ravaging India and other parts. Again, how does that play out?
I mean, it's a clear risk. The better news for the UK is that so far the evidence is that the vaccinations that we're using are relatively good against a lot of the various variants that are out there. But it sort of weighs on the economy in two ways. One is it creates that risk that we could see at some point down the line. We could see more lockdowns. We could see more restrictions. That means businesses across the country are going to be a lot more conservative about their employment plans, about their investment plans, until we almost know for certain we're out the other side of this pandemic. But it's also worth noting that because of these sort of variants across the world, these slower vaccine rollouts across the world, borders are going to stay relatively closed for some time. And that's actually could be relatively good news for the UK in some senses, because if we do see consumers in the UK being unable to go overseas, then their holiday spending may be spent locally, and that could help to support UK domestic spending as well. So there's a number of ways it plays out, but of course these big risks that are still out there in the global economy do come back to the UK, and that uncertainty probably holds back a little bit of the rebound, just because businesses are so uncertain about whether we go back into lockdown.
James, thank you so much. James Pomeroy there from HSBC. Now let's get straight to the Bloomberg First Word News. Here's Leanne Garrett. Hi, Leanne.
Hi, Francine. There are doubts that a patent waiver for COVID-19 vaccines has enough support. German Chancellor Angela Merkel has come out against the idea, with a spokeswoman saying it would create severe complications for vaccine production. It now falls to the World Trade Organization to take up that debate, but officials warn the talks could actually take months. Now, Wall Street's new overseer has laid out his agenda for increased regulation in a number of areas. Securities and Exchange Commission boss Gary Gensler made his first appearance before Congress since being sworn in. He pledged to look into the wild price swings of the GameStop saga, cryptocurrencies, and the derivatives that triggered the Archegos blow-up. And Bloomberg sources tell us the UK plans to offer under 40s an alternative to the AstraZeneca vaccine. That's due to concerns about blood clots that affect a tiny proportion of those receiving the shots. The decision could be announced as soon as today and comes as officials prepare to open vaccinations up to those who are aged under 40. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, coming up, keeping the pressure on China, the Biden administration is likely to proceed with the investment ban imposed by Donald Trump. We'll bring you our scoop next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get to the Bloomberg scoop. And the Biden administration is likely to preserve limits on U.S. investments in some Chinese companies imposed under Donald Trump. Bloomberg sources say the talks on the ban are still preliminary. Wall Street has been urging the Biden team to roll back the restrictions. But speaking in Louisiana last night, the president said the U.S. needs to remain competitive.
Chinese are eating our lunch. They're eating our lunch economically. They're investing hundreds of billions of dollars in research and development. That's why right now, if it keeps going the way, they're going to own the electric car market in the world. They're going to own a whole range. We got to compete.
Joining us now for more from Hong Kong is Bloomberg's chief Asia economics correspondent, Enda Kura. Enda, thank you so much for joining us. What does the news on the investment ban signal for U.S.-China relations?
Well, I think, Francine, it's a continuation of a theme. This was a measure brought in, a quite hawkish measure brought in under the last government under President Trump, and it essentially targets U.S. investments in certain Chinese companies that have links to China's military. Now, when it was first announced last year, there was some confusion around which companies would be impacted and how it would be implemented and so on. So there was some thinking that with the new administration, that perhaps this might be one of those policy areas where there could be some wriggle room between both sides. But the indications are now, as you mentioned, as our colleagues are reporting, President Biden looks like he's considering doubling down on this. It does speak to the idea that there hasn't been much change of tone really at all in the U.S.-China relations. The tensions continue over technology, over human rights, over economic competition. This idea now about targeting U.S. investments in certain Chinese companies just adds to the theme that there isn't really a circuit breaker in the U.S.-China tension just yet, and it looks like it's going to continue in the near term.
And China has also reported strong trade numbers. So what's the big takeaway from that?
Well, these were bumper trade numbers, Francine. Of course, there's a base effect, but when you look at them, exports grew over 30% in dollar terms in April from a year earlier. Imports up over 40% as well. It speaks to the idea that the world economy is rebounding as it opens up again. We know that global appetite for Chinese merchandise goods is very strong, and that's being backed, of course, by so much public support for economies around the world. And when you look through the figures, you can see big export growth, in particular, in fact, to the U.S. U.S. was China's biggest export market in the month, accounting for almost 16% of Chinese goods sold abroad, so really shaking off the impact of a trade war. On China's imports, it's a strong headline number, but we do need to remember, of course, the big run-up in raw materials prices and commodities prices, which is inflating that. But all told, these are a robust if not a bumper set of China trade data, and it speaks to a recovering global economy.
But the stronger the recovery in China, and does it make it likely that actually they can take on the U.S. more, or are the two unrelated?
Well, I think there's no doubt that China is in something of an economic sweet spot coming out of the virus now, Francine. As you know, I mean, they got it under control early in 2020. That allowed their manufacturing and industrial production to get going earlier than rivals. And they continue now to be in a strong place to capture the demand from the rest of the world as it opens up, as the US gets booming on the back of stimulus there, and as Europe gets going again. China is in well placed to make and sell all of its kind of merchandise goods that the world needs. It's everything from work from home kits to all, of course, the medical equipment that the world needs right now to fight the virus. So China, was obviously hit hard early on, but they've ended up in something of a strong spot. The recovery there is beyond, of course, the industrial and manufacturing base. Services and consumption is slowly recovering too. And even if there is a view that China's recovery may plateau or cool somewhat over coming months, all told, they're in pretty good position at the moment.
Yeah.
And certainly puts them on a good base when it comes to competing against the US.
And thank you so much, Arnda Curran. This is Bloomberg. Rising risk appetite becomes a concern for the U.S. Federal Reserve. The governor, Lael Brainard, says more granular disclosure may be necessary after the Archegos debacle. Bloomberg learns that President Biden is likely to keep up the Trump-era limits on Chinese investments. And Cathie Wood's ARK Innovation ETF slide another 3% as inflation fears take hold of investors. Coinbase plunges to its lowest level since last month's IPO. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, English election results are coming in with the northern town of Hartlepool going to the Tories for the first time since the constituency was created in 1974. Scots are also waiting on tallies, which could pave the way to a second independence referendum. Well, joining me now to talk about all things UK and politics is our executive editor, David Merritt. Dave, good morning to you. I know you also helped us, of course, follow Brexit from the very beginning, and this is kind of a continuation. First of all, if you look at the UK as a whole, I guess the biggest concern for Boris Johnson is how he keeps the union together. Which way will Scotland go?
That's right. That is the kind of bigger question politically, but also for financial markets about this election. Yes, that Hartlepool gain is very striking and shows Boris Johnson continuing to make inroads where the Tories never have before in England. But in Scotland, we're not going to get any results actually for this today. The counting's all been a bit delayed from normal processes because of the coronavirus restrictions. So it's probably not going to be till the weekend. Now, we know that the Scottish National Party's Nicola Sturgeon is going to win. There's no doubt about that, but it's the scale of her victory that's going to be crucial. If she can get an overall majority in the Scottish Parliament, that is going to give her fuel to demand another referendum about Scottish independence in the course of this Parliament. It might not happen this year, but in the coming years. And that, of course, has huge consequences for the entirety of the UK. Polls showing it really neck and neck whether she would win that or not.
I'm looking at Hartlepool. I mean, this is, swinging to the Conservatives from Labour for the first time. What exactly is the implication of this? First of all, is it all about vaccines?
That's right. There's a few things going on here. There's obviously Brexit. This was a very Brexit-supporting bit of the country. But also, there is this bump coming on from the vaccines. Coronavirus numbers are plunging. People are feeling good about the economy unlocking. So Boris Johnson riding a bit of a wave for that. But it is remarkable for an incumbent government to win a seat like that. Very bad news today also for the Labour Party and for Keir Starmer.
What does this mean about, the popularity of Boris Johnson right now? So is it a vaccine rollout that actually he will almost be forgiven for anything? I mean, there's the, curtains for cash scandal. There's the Greensill concerns. Is that going to be forgotten by the citizens in Parliament?
It is amazing, isn't it? Seemingly he can do no wrong when it comes to the voters. But in so much negative press, hasn't there, over the last few weeks? This so-called sleaze allegations against him, who paid for his flat redecorations, all these money problems. The voters don't seem to care. compare, the Labour Party seemed to have made a big strategic error here, focusing in on that negative campaigning, when actually the bigger picture is, as I said, the economy is reopening, the sun's coming out, people have been vaccinated, the majority of people, and people seem to still, in England, of course, this is not the story in Scotland, but in England, they still seem to like voting for Boris Johnson's party.
What's his biggest challenge away from, I mean, there's Scotland, but at this point, Dave, if he's doing okay and actually despite some of the sleaze scandals, he's still winning in certain parts that had never voted Tory before, does it embolden him? Does it change the way that he wants to govern this country?
Well, you know, this was part of the agenda that he has about levelling up. That's a big part of this strategy to grab these seats in the north of England. But of course, he's got a big problem on his hands with this, which is how to pay for it. You know, we know we've had, the public finances are in the worst state that anyone can remember, the deepest recession in 300 years. So how do you pay for infrastructure? How do you level up, as his agenda has it, when there is no money in the Treasury? And at some point, there needs to be a financial reckoning. It's a question for Rishi Sunak, of course. But as we come out of this huge economic slump and the economy recovers, how much money is there going to be available to pay for all of these promises that he's made to those seats? Because he's going to have to stump up some cash in order to convince people that he was telling the truth. And in fact, he does have a levelling up agenda. So time will tell for that over the coming years.
I mean, I know we spoke a lot about, you know, the fish fight raging on with also Navy ships being sent to Jersey. What did you make of it? And are we going to have these skirmishes that, frankly, surprise many, because this is the UK and France we're talking about?
Yeah.
Are we going to have this sporadically?
Yeah, war with France probably not on the agenda at the moment. It's all a bit of posturing, wasn't it? You know, great headline grabbing. Boris sends in the gunboats to defend Jersey. But it is a symptom, isn't it, of how tetchy relations still are with the European Union. You know, Brexit may have been done in terms of the trade deal, but, you know, the wrangling is going to continue. And whether it's about fish or whether it's about things like financial services, a lot of these issues still have not been resolved. And I think it's a sign of things to come for many years that Britain and the EU are not going to have this very cooperative relationship. Perhaps for some time there's going to be tetchiness, there's going to be spats. But of course that plays quite well politically for both sides of the channel. Mr. Macron, of course, is up for election himself next year in France. And no side wants to be seen to be caving in to the other. Unfortunately, that means a little bit more economic turmoil, perhaps, particularly when it comes to things like financial services in the years to come.
Dave, thank you so much. I have to say, Dave, one of our opinion columnists, Therese Raphael, who's very good and very funny, just tweeted something. Which of these is more likely to have hit rock bottom, Arsenal or the Labour Party? So we'll have to get you back on to discuss that as well. David Merritt there talking about the election, Scotland, and the future for Boris Johnson. Now, the world of sustainable investing has ballooned in the last 5 years from a fringe corner of the market to a significant portion of the market. New analysis by Bloomberg Intelligence suggests that ESG assets can make up more than a third of global assets under management by 2025. That's more than $53 trillion. And though Europe accounts for half of the ESG assets currently, the US would overtake the region by as early as 2022. Well, joining us now is Marie-Jacques Cardoen, Edmund the Rothschild Asset Management Global Head of Distribution. Marie, as always, thank you so much for joining us. I think it's the first time that you come on Bloomberg Surveillance. When you look at the appetite for ESG, there's been a big wave, especially in last year. What are your clients asking that actually asset managers provide in terms of ESG, and how much will that grow in the future?
Thanks, Francine, and thank you so much for having me. I think you're right. The last year has been a pivotal year in terms of investment in ESG. It's accelerated certainly the interest and the commitment to sustainability. And we've shown flows in European ESG funds, for example, doubled to reach 230 billion. And we've seen, I think, 500 new ESG funds launched. So definitely a huge interest from investors in Europe. And of course, we're also witnessing new regulation that encourages flows into ESG. In particular, to meet the EU goal of a net zero economy by 2050. But of course, there was the European Commission SFDR implementation in March this year. And that has prompted asset managers to classify and categorize their funds in terms of how they score from an ESG perspective. So, for example, at Edmund Rothschild, we now are reporting that 85% of our products are Article 9 or Article 8. And that's really something that investors are asking for.
May, is there a concern that actually a lot of investors will then get confused because they say, well, we're being sold products, but I don't know what we are on taxonomy, that because we don't have common definitions, because actually almost each company, certainly each region and country look at things differently, until we get a more robust framework, that it's going to be touch and go.
That's right. And I think the reality is that most investors are not only looking at the risk-return ratio now, but they're really looking at risk-return and impact, or risk-return and purpose when investing. And they're faced with a couple of challenges still, and they're mainly linked to two things. I think the first thing is the definition, as you say. It's still really difficult to identify and define the universe, because there is no real consensus about what ESG really entails. That explains why it's so critical for investors to be able to get access to meaningful data and metrics. And so what we've done at Edmond Rothschild is we signed a UN PRI, but we've also decided more than 10 years ago to actually build our own proprietary model where we use more than 50 criteria that we review on a regular basis. We've also incorporated the 17 Sustainable Development Goals from the UN. And we're using that model to be able to assess, to measure, and to score companies from an ESG perspective, and then use that when investing in stocks in our portfolios. So that approach, proprietary approach, is fully integrated in our portfolios. And that's a way to differentiate. The other thing that I think investors are struggling with, and that comes up quite regularly in the debate about ESG, is performance and whether or not ESG is generating alpha. And look, when we look at studies, and our own experience is that ESG creates a virtuous circle in the long term. Our experience is that companies that score well from an ESG perspective are financially performant in the long term. They tend to be more resilient, and as we've seen last year, they also provide a good downside protection in times of crisis. The interesting thing now,
No, finish, and then I have another question.
I was just going to add that from a risk management perspective and innovation incentivization, I think it's also interesting to see that ESG, companies that score well in ESG tend to perform better. Now, you talked about mainstream, and you talked about a lot of investors going into ESG. I think one point that's interesting to see is that portfolios that are fully ESG integrated, when we look at data, tend to perform better than those who are integrating an approach that's purely based on negative screening.
Mike, very quickly, do you see a shift from climate change to also the most social aspect? So because of COVID, because people are much more aware about diversity, people in the workforce that have been displaced because of COVID, do you see that opening up as a space for investors?
Yes, certainly. Certainly the crisis has led to the social aspect in the ESG context to become more prominent. And look, the spotlight is really now on companies' social practices, on how they treat their employee and their safety and health. Have they maintained wages during the crisis? Do they have insurance schemes in place for their employees? And that's, I think, really interesting in the context of more broadly human capital, and how being best in class in terms of managing human capital as a company is also creating added value. It's a topic that hasn't really emerged last year. It's been a catalyst rather last year, but studies had started way before. And what's interesting is that if you look at the last 25 years, the annual average alpha that's created by companies that have a best-in-class human capital approach is around 3 to 3.5%. So we've launched a human capital strategy to give investors access to that added value, and I think that's really exciting.
Marie, thanks so much. Marie Jacot-Cardoen, they're Edmond de Rothschild Asset Management Global Head of Distribution. Now, coming up, the co-founder of Atomico, the VC behind Klarna, Viagogo, and Stripe, has a new venture. We talk next to Matthias Lungman about his new Moonfire fund and the philosophy behind Zoom investing. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Moonfire Ventures has just launched its first seed fund. The company, started by Atomico co-founder Matthias Lungman, has raised $60 million. Formed in 2020, Lungman went through the process of founding, raising capital, and investing entirely remotely. Now he's using that experience to do what he calls Zoom investing, which is data-driven venture capital that looks to leverage the change in behaviors caused by the pandemic. Well, I'm delighted to be joined by Matthias Lungman now. Matthias, thank you so much, first of all, for joining us. I know yesterday was a big day for you. I guess today, day two, is also another big day for you. How will this be different to Moonfire 1.0?
Yeah, so it's wonderful to be here. Thank you so much for having me on the show again. It's exciting times in tech, and as you said, we're sort of seeing a booming of the sort of next generation of European founders coming out, and for us, we've also seen a big change in that there's literally a sort of a death of geography where people are focusing, on Zoom investing, and for us, that's come very naturally as we were born in the sort of era of the pandemic, where we built the whole firm, brought in investors, and raised a fund in this new world.
So, Matthias, how do you see our worlds changing? How will we, I guess, what we've lived through in the last 12 to 14 months, the fact that we communicate like this, that we do television interviews only by Zoom or Skype, that we communicate in meetings, how much of that will change once we go back to maybe a more normal life? And I don't know whether normal is the right way of describing it either.
Yeah, look, I mean, it's clear there's a bifurcation of the economy, right? Where we're seeing that there's one component of the economy, the older part, which is actually struggling in this current environment. And you're seeing the tech side really continuing to grow. We're seeing one new unicorn being created in Europe every week. And in sort of, we're sort of fit for purpose. So the areas also that we are focusing on, fintech, future of work, gaming, and e-health are all seeing a big pickup, and like you mentioned, what is happening in the world of future of work, and we can definitely see a dismantling of the traditional way of thinking about work, and how we work, where we work, and what we do is very different today, and I think that's going to continue. I think the pandemic just all it did was move things forward much more quickly than what we had before, but that was a trend that was happening anyhow.
But so how do you explain this boom? Is it just accelerating, I guess, the trend that we were seeing before? Or is there something exciting about the European, tech scene, startup scene at the moment?
Well, look, the numbers almost speak for themselves. In the first quarter of this year, we had 21 billion euros of exits. That was a lot bigger than all of last year. We had a further $20 billion invested in Q1 compared to 40 billion last year. So, why is that happening? And I think that's a really good question. And ultimately, what we're seeing is the compounding effect of many years of growth, faster growth in Europe than what we've seen in the US and in China, suddenly coming into play. And what you're having these big outcomes where, you had UiPath listing recently, now worth $37 billion. And you have Adyen up at 60 billion, and the same thing with Spotify. And they're creating the next generation of founders. So not only do you have more billion-dollar companies, but they're also the depth and strength of those big companies are providing a good breeding ground for the new generation of founder.
Is there a difference now between European tech or European startups and the US? I was, in the past, one of the concerns was that there was just not enough money for that critical mass kind of expansion in Europe, which we saw in the past a lot of big companies always coming from the US. Is that changing?
I think we're seeing that beginning to happen now properly. When you're edging towards $100 billion companies, tech companies in Europe, it's really exciting. And I think the reason why things are growing so quickly here too is because we're getting that international interest. There's a lot of both Eastern and Western investors, but people coming from the Silicon Valley looking at our companies, interested in what's happening here. And it's the shift that happened during the pandemic was enormous. And so they're definitely engaged in Zoom investing. And many of them are also setting up shop here in Europe. So you have Sequoia, Lightspeed, General Catalyst, all opening up offices. But I'm looking, when I'm bringing companies out, when they're looking for their next round of funding, what used to be 20%, let's say, U.S. investors is now moving up to 50 to 70%. And that's all really good for the founders and our ecosystem as more money is going in and helping to breed the next generation of innovation.
Matthias, thanks so much. Matthias Lungman, their Moonfire Ventures founder and managing partner. Now, coming up, a Doge and a pony show. We discuss why a comedy show on Saturday night is shaping up to be a market event for crypto traders. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance, the early edition. I'm Francine Lacqua here in London. Now, let's have a look at what's going on with a lot of these pharmaceutical companies. Yesterday, you remember, if you look at BioNTech and some of the others, they really fell out of bed. I mean, that's a very British expression, but they were sold because we understood that the U.S. was behind this waiver of IP. This would be a good thing for global inoculations. Bad news from some of their shares. But we now understand that actually Angela Merkel in Germany would be behind intellectual property being kept for vaccinations. And so we're getting a little bit of a boost for some of these vaccine makers. Now, let's talk about crypto, because every Doge has its day. This week, it could be on Saturday when the self-proclaimed Doge father, Elon Musk, hosts Saturday Night Live. Now, ahead of his appearance on the American comedy show, Dogecoin has staged a massive rally to become the fourth largest cryptocurrency. I could talk about it all day, and our Danny Berger's here to break it down. Danny, I mean, let's think about this. Are we really at the point where we can say SNL is now a market event?
Yeah, we are at that point somehow, Francine. And look, just to put this out there, and maybe this speaks to the times too, I'm way more used to bringing you some like esoteric options thing up here, not this video of Shiba Inus. So I think, this is an interesting change for us as well here. But look, we are. I think, this new culture of meme investing is a lot behind Elon Musk. Elon Musk really epitomizes this sort of idea we're investing in meme. I mean, look, this is what he tweeted out last night, as you said, calling himself the Doge father, promoting his SNL appearance. So by all accounts, everyone is saying, okay, he's going to have some sketch about Dogecoin. People are going to jump in. They're going to go buy it. And we're getting this viewpoint from very serious market analysts. This is from Edward Moya of Owanda, who usually is talking about like dollar strength or that sort of thing. Mike Novogratz had a 22-page report on Dogecoin recently. But, as much as people try to take this seriously, I don't really think that's the approach here, because the reason it does so well, the reason it's so valuable is because of its meme status, is because it is really fun.
Yeah, and it's a very cute dog as well. Yeah. I don't know, is there an implication for other cryptos?
I mean, I think that there is some concern in the wider community that if you take this as a joke, then, how do you take Bitcoin seriously? I don't think that that's a welcome attitude, really.
All right, we need to talk about this even more, and we're definitely watching SNL this Saturday because it's a market-moving event after all. Danny, thanks so much. Our Danny Berger there on crypto and Dogecoin. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller joins us out of Berlin, Kailey Leinz in New York. It's Jobs Day. We'll look at, of course, what we heard from Lael Brainerd of the Fed. We also look at vaccine makers. This is Bloomberg.
Every single thing, from the deck of an aircraft carrier to a railing in a new building, is going to be built by an American company.
We have some capacity to expand production, but eventually we will reach capacity constraints.
We've been clear today, we have not changed the stock quantitative easing that we're doing this year. So what we've changed is the pace at which we achieve that stop.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua, Matt Miller, and Kailey Leinz.
Well, good morning from London, Berlin, and New York on this Friday, May the 7th. Our top stories today. Million job milestone. Today's jobs report is likely to show that easing restrictions are bringing more Americans back to work. This comes as the Fed warns of rising risk appetite. This ARK has hit the rocks while Cathie Wood's ARK Innovation ETF falls another 3%. The fund's being hammered by a slump in highly valued tech shares. And Biden stays a course that was set by Trump. The U.S. is likely to maintain pressure on Beijing by keeping those limits on American investments in key Chinese companies. It's Jobs Day. Happy Friday, everyone. But I don't know whether, Kailey, we can say Happy Friday until we get the jobs report out of the way. It was give us, of course, an indication of what the Fed does. And then I'm really looking forward also to Matt Miller's interview on inflation with Siemens, because you see a lot of these companies, pushing the price hikes through to customers. But overall, Kailey, it's actually quite a big market day.
Yeah, it absolutely is. You have that inflation story. You have the labor market. That right there is the Fed's dual mandate. So the market really in a holding pattern, waiting for 3.5 hours time when we get that read. As for what the picture looked like in the Asian session overnight, you did have some stocks higher, including Japanese equities just marginally, but you did have Chinese stocks down 1.3% and Hong Kong stocks under a bit of pressure as well. Now, you did have strong trade data out of China, imports and exports surging, but risk appetite being weighed down a bit by what Francine just mentioned, the Biden administration potentially keeping that investment ban in Chinese companies in place. I would note the Chinese yuan is stronger against the dollar by around 0.2%. The Japanese yen, though, slightly weaker, sitting at 109.15. As for what the picture looks like in another region of the world, in Europe, it is mostly green across the screen. You do have a little bit of underperformance coming from the CAC in Paris, but the DAX higher by 1 percentage point and the Stock 600 up by about 0.4%. I would note that in foreign exchange, euro dollar is approaching 121. We aren't there right now, but the euro is stronger against the dollar, sitting at 120.86. And in the commodity complex on the London Metal Exchange, copper, a new all-time high right now, trading at $10,263 as that commodity rally rolls on. As for what the picture looks like in the U.S., futures have been fluctuating a touch, but at the moment they are in positive territory, up 5 points on S&P E-minis. Not a lot of action in the Treasury market. Again, we're awaiting that jobs report. The 10-year yield sitting at 1.57%. The dollar flat to slightly down. And of course, the Bloomberg Commodity Index higher for a 6-day mat, and the Bloomberg Commodity Spot Index at its highest since 2011. Commodities still just the hottest thing out there.
Yeah, and this is a huge part, Kailey, of my interview with the new Siemens CEO. This is a very global company with more than 200,000 employees. They sell products to everybody in automotive, medical devices, power generation, and they need those commodities, right? So as those prices rise, Siemens has been able to increase prices to customers. And those aren't the kind of things that they turn around later and reduce. So those are not transitory price increases if you're buying Siemens stuff, and if you're a giant manufacturer, you probably are. Let's take a look at what's going on today. Of course, it's all about the U.S. April jobs report. Even the low end of expectations is still pretty high, over 800,000. We're going to get the numbers at 8:30 a.m. New York time. Then following that report, Mike McKee is going to speak with the Minneapolis Fed President Neil Kashkari. Very dovish. We'll see what Neil has to say. Then we're going to get the Biden administration's view on the report with U.S. Labor Secretary Marty Walsh at 9:45. So, Fran, this should be a very big number. It could be over 1 million jobs added. And the question is, do we continue in this direction? Because as you know, we're going to speak to some people on this program today who think, once again, that growth may be peaking in this quarter.
Yeah, I guess, this is the trillion-dollar question that will, of course, underpin everything. Is at some point, is the economy overheating? And if it is, what does the Fed do? Now, the Federal Reserve, Matt, also warning over asset prices in its semi-annual financial stability report. It says rising appetite for risk across a variety of asset markets is stretching valuations and creating vulnerabilities. Well, joining us now, Danny Berger with the very latest. Danny, what seems to be the consequence of the Fed bringing up, once again, it's not the first time, asset prices?
Yeah, well, I think this time, it probably does surprise investors to some extent because they were already surprised when last month Powell used the word frothy. Well, this time they're talking about meme stocks, not once, not twice, but 3 times they mention meme stocks in this. So it's really as close as they could get to talking about there being a bubble in markets without actually saying the word bubble. So here are the 3 kind of different categories that they mentioned. So, what do you go about doing this? We've heard from Kaplan a couple weeks ago, who talked about perhaps, this brings into question asset purchasing. But Powell has been very clear that this isn't enough to make him tap on the brakes. And to that, someone like George Selgin from Cato Institute would say that there's something contradictory about this if the Fed is warning about this excessive risk-taking, which has been caused by the Fed's very easy policy.
Well, Danny, I look at what you have up there on the screen, IPOs, SPACs, meme stocks, all of those have come under pressure within recent days, including the ARK Innovation Fund, Cathie Wood's flagship.
Yeah, you're right. That ARK fund falling again, the IPO index falling pretty heavily yesterday as well. And so I think that this perhaps stops short of maybe what the Fed wants, of investors wringing excess out of the market. But something strange is happening in that these stocks are falling. Concerns about valuations, concerns about inflation, maybe concerns about Matt's interview with Siemens about raising prices and passing them on to the consumer. But the bond market isn't doing that. Real yields are falling. That's not bringing back growth appetite. And if you look at what financials and the yield curve have done over the past week, financials have a bid, but the yield curve has been flattening. So bond market saying something very different than what equities are saying at the moment.
Danny, how are you going to watch Elon Musk on Saturday Night Live? That's like 4:30 a.m. London time, 11:30 Saturday night. Are you going to wake up early on Sunday?
No, I'm staying up. I'm going to get a cup of coffee. I'm going to have my CoinDesk monitor up, watch and see what Doge does. I'm ready for this. I'm very ready for this.
Spoken like a true millennial. Through the night. An all-nighter. Yeah, probably a couple cocktails before that. Elon Musk is on SNL. We are all excited about that. Let's get over to Enda Curran, though, right now, because we have a Bloomberg scoop on China. The Biden administration is likely to preserve limits on U.S. investments in some Chinese companies imposed under former President Donald Trump. Bloomberg sources say the talks on the ban are still preliminary, but Enda Curran, our Asia economics correspondent, joins us now to talk about this. Biden is pretty much holding the course on the Trump-China policies, isn't he?
I think you're quite right, Matt. It's something of a continuation of a hawkish theme. This is a policy they inherited from the Trump administration. If you remember last year, it was rolled out to target U.S. investments in certain Chinese companies that have links to China's military. And at the time when it was announced, there was a lot of confusion about who would be impacted and how it would be implemented. There was pushback from Wall Street and investors. And the view was that perhaps with a change of tone with the new administration, this is the kind of policy that maybe might go back on the table and be looked at again. But the indications, as you mentioned, our colleagues are saying out of D.C. is that President Biden is looking at this again, but they may in fact double down on it. And it just reinforces the idea that there is yet no circuit breaker in the China-U.S. tensions over human rights, over technology, and over the economy. And if they do go ahead and push through these restrictions, it reinforces the narrative that there isn't going to be any near-term game changer when it comes to China-U.S. relations.
All right, Bloomberg's Enda Curran in Hong Kong, thank you so much. Now, of course, another story we continue to watch is the developments and debate over waivers for patents for COVID-19 vaccines. And it is once again moving the market in free market trading here in the U.S. this morning. Of course, the Biden administration on Wednesday expressed support for those waivers. So we saw a number of stocks come under immense pressure early on in the Thursday session. But then German Chancellor Angela Merkel came out in opposition, and we saw those stocks start to recover. That is once again the case in early hours this morning. CureVac up by a little more than 7% in pre-market trading. Novavax by 2.3%. And elsewhere, of course, we still have earnings rolling out. Roku topping expectations when it comes to the forecast. Even as the economy reopens, a lot of demand for its streaming video. That stock up the better part of 8%. And Peloton, of course, easing some investor concerns about the impact of the recall, the safety recall of its Tread Plus treadmills. It says it'll only knock about $165 million off of revenue. That is not as bad as feared, and as a result, the stock up 6.5% before the bell, Francine.
Thank you so much, Kailey. There's so much going on. It's going to be a fun show because we're looking at jobs. We're also all thinking about SNL with Elon Musk and Doge. Now, coming up, Salman Ahmed, Fidelity International Global Head of Macro and Strategic Asset Allocation. He'll have a thing or two to say about U.S. jobs. And then after the U.S. jobs report, Bloomberg's Michael McKee in conversation with the Federal Reserve Bank of Minneapolis President Neil Kashkari. That's at 8:30 a.m. in New York, 1:30 p.m. in London. A possible market-moving interview, so don't miss it. This is Bloomberg.
We have a price increase in raw materials as well, but also in the freight costs. And in our short cycle business, we have put that into our price. So we have a price increase, slight price increase in order to compensate for it. So therefore, I would say this is contained. And you can see it also from our results. We increased, for example, in DI. We increased our margin now in this quarter to a 20.1%, which is an extraordinary margin. But also the margin of SI going up to above 11%. So therefore, I do believe that we have that quite under control. But again, you have to watch it closely.
All right, so Siemens CEO Roland Busch talking with me this morning saying that input costs are rising. They're passing those costs on to their customers, and they're even able to boost margins. So you can guess that they're boosting prices even higher than their input costs are rising, unless they're cutting costs somewhere else so much. That doesn't sound very transitory at all, because they're not likely to cut those prices for their customers later. Joining us to talk a little bit about this and give us his general outlook for the economy is Salman Ahmed. He is the global head of macro and strategic asset allocation over at Fidelity International. Salman, what's your take on transitory?
Good morning, Matt. I think we are skeptical about this characterization of transitory. And just to add to the interview you mentioned with Siemens CEO, we do a broad-based survey of almost all companies in our coverage at Fidelity. And our surveys show that across the board, especially in the US, but across the board globally, we are seeing a big momentum towards increase in input costs, both from labor and non-labor. And there is this idea of pricing power coming back, and it's likely to be sticky in nature. And then, of course, there are supply side issues, but there is also demand side pressure coming up because of the fact that there has been so much fiscal transfers given to the household sector. And it's all, looking at underlying inflationary pressures at the very bottom up micro level, which at least are not still showing up at the top down level.
But so, Salman, given what you've just said and what we heard from and commodity prices, then there's a very big argument to say that the economy will overheat, and that would put some of the central bankers, or certainly the markets, on a back foot.
Definitely, even though the Fed Chair Powell keeps telling us that he's not ready to talk about the talk of tapering, the only thing we are thinking about is tapering. Because this current Fed configuration and stance looks at odds with the data we are seeing. Of course, the non-farm payroll report will be important to watch as well on that front. But overall, if we zoom out of it, in terms of the new regime, we are thinking about a boom-bust cycle type of regime, because the volatility of policy will have to increase to match the volatility of data and of course, the shifts we are seeing.
So what does it mean for markets? If you look at even the warning from the Fed saying that actually there are just markets that in certain cases, I'm paraphrasing, are mispriced, where do you want to stay away from?
So we have been very concerned about the very high valuation froth, if you will, which was mentioned by Chairman Powell for some time now. So we have been working on sectors which we think have, valuation support, will benefit from the reopening theme. Yes, it has been a non-linear, jerky journey, but we still believe in that theme, that the rotation can happen. So we're trying to stay away from some of the expensive parts of the market. And sometimes it gets tested, but we think that is the right way to go, because the Fed will not be able to keep the 120 billion per month pace. They will have to slam the brakes at some stage, and the probability that they will have to slam it very hard is increasing. And then the other side, we are also thinking about bond markets. We are not comfortable with where yields are at the moment. Although the volatility of bond yields have come down recently, we think there is another taper trend shock in the pipeline. So we are already thinking about it and expressing that through our tactical asset allocation grids and matrices.
So in your view, the downside risks are far greater than the upside ones?
At this stage, yes. We think the balance of risk is towards pressure on the market and most likely coming through an increased bout of volatility in bond markets, even though right now it's a little bit of a calm, but we think this is a calm before the storm, because the underlying bottom-up inflationary data does not tally up with what the Fed is telling us.
So the idea that growth, earnings, even stocks have peaked sits well with you?
I would actually nuance that because I think the sector stories are becoming very powerful. So I think where we are focused on is the rotation right now. So to try to think about the areas which are expensive, are linked with the negative real rate environment, which the Fed is supporting so far. So we want to avoid that and focus on areas where, which is more cyclical areas linked with the commodity cycle, which is going on. And we get, most importantly, we get some valuation support, and we don't have to worry about whether this is expensive or not. So this idea that valuations are high is not sitting well with us in some parts of the market.
Well, Salman, you mentioned negative real rates there, and we've seen them become more so in recent days, and yet we haven't seen the corresponding move in big tech that you would expect. Why that breakdown?
I think this relationship plays out over a longer period of time. So from a day-to-day perspective, this can be quite volatile, and I take your point on that one. But I think the underlying theme is, especially when some of the baskets we watch are non-profitable techs, they are coming under pressure. And then that's the relationship which comes through the negative real environment. And the volatility is also a factor here. So not only real rates have to go up, but if they do go up in a volatile manner, that plays up as well. But it's from a more medium perspective, we're still confident that that relationship exists.
Salman, thanks so much. Salman Ahmed there, Global Head of Macro and Strategic Asset Allocation at Fidelity International. Now, coming up tonight, be sure to watch Money and Equality, hosted by our Shonali Bazak and Romain Bostic, a special report on how the financial industry is dealing with inequality in the U.S. economy. That's at 7 p.m. in New York, midnight in London, and this is Bloomberg. This is Bloomberg Surveillance, the early edition of Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now let's get straight to the Bloomberg. First word news, and we start with President Biden stunning European allies and drug-making industry with his support for waiving patent protection for coronavirus vaccine. Now that was a reversal of a long-standing U.S. policy that its company's intellectual property is sacrosanct. But there are signs that the president is also interested in a more modest compromise. Meanwhile, Germany has said it opposes a waiver, and shares of companies rose on the back of that. JP Morgan Chief Executive Jamie Dimon wants Congress to spell out targets for building roads, funding college degrees, and creating jobs. That's if lawmakers approve President Biden's massive spending measure. In an interview for the Investment Company Institute, Dimon says just throwing money, it doesn't work. This is a quote. He also said that if taxes are raised, there should be an itemized list of how the money will be used. And in China, exports rose more than expected last month because of growing global demand, and imports jumped on surging commodity prices. Exports grew 32% in dollar terms for a year ago. Imports were up some 43%. And finally, the British Prime Minister Boris Johnson has dealt a major blow to his chief political rival. Johnson's ruling Conservative Party won a crushing victory in the parliamentary district of Hartlepool. Now, it had voted Labour every time since the seat's creation in 1974. The loss is likely to intensify pressure on Labour leader Keir Starmer. Now, I know we're going to talk a little bit about also the future of Scotland in all of this, which is probably the biggest worry now and difficult thing for Boris Johnson to deal with. But Matt, overall, if you look at where Boris Johnson is, last week and the week before, we were talking about the sleaze scandal. We're talking about the curtains for cash scandal. And it seems that because of the vaccine rollout, actually, he still has a lot of support, certainly in certain parts of the country, for the Tory party.
Yeah, well, they've obviously done an incredible job with the vaccine rollout, but you would have thought with all of the negative press coverage on the scandals and all of the negative coverage on lockdown, open up, shifting policy, waffling is what we would call that in the U.S., that he wouldn't do, that the Tories wouldn't do as well. It's a real surprise, at least to me, from this vantage point, that he did do well.
Is the sleaze scandal just over now? Are we done with that? Have we moved on? The news cycle changed and, forget it ever happened, Francine?
No, I mean, there's still investigations going. So usually the UK, does these Treasury Select Committees pretty well. And he's facing two things, right? First of all, is donations for the refurbishment of his Downing Street apartment, which is actually quite small and just above the famous black door that you see. And the other one is about, ties to like Screensill and lobbying. But it's very clear that actually if you're a voter, Maybe in this kind of case, you remember the thing that they did well in the last time. I mean, you have maybe a short memory as a voter.
Yeah.
Is that the takeaway?
And maybe you don't care if he refurbished his small apartment on Downing Street. I mean, that's not really an issue that affects British people in, towns and hamlets outside of London. It's
maybe the pandemic just tops everything.
Maybe, but then, do you need that amount of money to refurbish a small place? A conversation for another time. Luca Paolini, Pictet Asset Management Strategist, is coming up shortly. This is Bloomberg. This is Bloomberg Surveillance Early Edition on Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, it's Jobs Day. I'm quite excited about Jobs Day. I'm also excited about a couple of other stories, Matt, that we've been talking about. But look, Jobs Day will give us an indication whether the economy is at danger of overheating. And, of course, this has implications for the Fed. I'm really looking forward to Michael McKee's interview with Neil Kashkari.
Yeah, well, I'm always looking to hear what Kashkari says. I think he's pretty far out on the dove spectrum, so sometimes he brings us statements that seem kind of out there considering how conservative the Fed usually is. So that'll be cool. Also, the change in non-farm payrolls. The whisper number right now is for adding 1.1 million jobs. So we could see a big number today, Francine. Even if we get the low end of the spectrum, we're still talking about adding more than 800,000.
Yeah, and you wonder, and I know there's going to be then all the analysis of what comes after that, and we can continue on the trend. So, Kailey, how's it playing out in the markets?
Well, we're really just waiting for this jobs report coming in 3 hours' time, Francine. Of course, Jerome Powell has said he doesn't want to see just one strong payrolls report. He wants to see a string of them. What a string means, I'm not quite sure, but we have to keep that in mind. As for how we are picturing markets right now with 3 hours to go until that jobs report, we are higher in the European session. The stock 600 up by about 0.4%. And here in the U.S., futures are on a firmer footing after fluctuating a bit earlier. We're up about 5 points on S&P E-minis. As for what's going on in the bond market, we're just waiting and watching. Not a lot of action when it comes to treasuries. The 10-year yield sitting right at 1.57%. And then, of course, in the commodity complex, the rally rolls on, and copper, the poster child of that this morning, in the London metal trade, hitting a record high. We're above $10,200. As for some stocks moving in pre-market trading, aside from the jobs report and Elon Musk on SNL and Doge, we also are still in the middle of earnings season, and there are a number of stocks moving on the back of their results. To the upside, Square higher by about 3% in early trading. Its revenue tripled, and part of that has to do with Bitcoin sales, providing a boon to the company. To the downside, though, Beyond Meat missing. It is really struggling as some restaurants and stadiums remain closed. That stock moving lower by the better part of 7%. Also lower is TripAdvisor after its results. And then I would point to the ARK Innovation ETF, coming off 8 consecutive days of losses, the longest losing streak since 2018, down 15% over that time. But at least right now, at this point in the pre-market session, we're fractionally higher, up about 0.1%, Matt. So we'll have to see how things shake out come the opening bell in about 4 hours' time.
Yeah, that's fascinating, the ARK drop. And I'm thinking maybe people who threw their stimmies into ARK and some of the meme stocks or the fast growth technology stocks now are starting to need the money for life and maybe pulling that out a little bit. It does look like if you've done well in the U.S., you've saved a pretty sizable nest egg. Take a look at this chart. And for those of you listening in radio, I'll just tell you that it goes up on the right side like Al Gore's hockey stick. It's unbelievable the amount of money. 18.8% is the amount of U.S. personal savings as a percentage of disposable income. And the question is whether that is going to be unleashed in a torrent of spending at some point, or whether those people are going to be using it to pay back debt, to invest maybe, to do other things than go out and buy consumer goods and drive the economy. Joining us right now is Luca Paolini, Chief Strategist at Pictet Asset Management. And Luca, you think that growth has peaked. You think corporate earnings may be peaking as well. What do you make of this savings chart, this massive nest egg that not only Americans have built up, but we also see similar figures in the UK and in Europe?
Well, I think, when we look at the consumer spending, you're totally right. I think the amount of potential spending is there, but we already see retail sales well above trend pretty much everywhere. I think there is also a Fed analysis showing that of all these savings, 40% only will be spent. So I think, when you look at the economic data, it's difficult for me to think that, especially in the US, the numbers will get even better. The US economy is overeating. We're talking about a 10% growth this quarter. Can it get really much better without stoking inflation? I don't think so. And this is why I think the risk for markets is actually rising.
Look, yesterday I spoke to the Bank of England Governor, Andrew Bailey, and this is what he said on basically, what would take the Bank of England to add QE next year.
We would have to have some, severe disappointment in terms of the outcome. So an obvious case in point, sadly, would be the return of COVID in a big way, which caused further economic dislocation. Now, we're not forecasting that at the moment. We don't see the evidence of that, but it would have to be something that, caused...
Like a shock?
That's, yes, a negative shock of some sort.
So, look, I guess this is, what markets are focused on is asset prices. It's kind of the talk of tapering and how inflation fits into all of this.
Yeah, I think, look, we're still positive on corporate earnings. So we are not kind of saying that we are entering a new recession or something like that. No, I think the economic data is strong. The problem here is that the markets are priced for perfection. That is a continuation of this strong growth. At the same time, the Fed remaining on the sidelines, which I think is very difficult because inflation is picking up significantly already. And yes, we can say unemployment is still relatively high, but of course, that's always the case after a recession. It takes time. So I think the combination of high valuation, Fed tapering, I think sooner than expected, I think could create a situation for markets where I think it's difficult to sustain the pace of growth that we have seen in the past few months.
What seems to be in I don't know whether it's a bubble or frothy, Luca. Is there something in the market that you're staying away from because you're expecting an imminent correction?
Well, look, we have been overweight equities for quite a long time. We decided to basically reduce our equity exposure because, yes, I think there is now still more on the downside, positioning, valuation, peak in economic momentum. But it's difficult to see anything but a kind of short and not even a significant correction because at the end of the day, the economic data continue to be solid. So I think we're going through a phase of consolidation, but we're not going through a phase of steep decline in asset prices just because, again, the fundamental story remain positive. And if you look at earnings, they're absolutely booming. So I think we are expecting a phase of consolidation, not a phase of steep declines for markets currently.
Well, Luca, you're also trimming your exposure to the cyclicals, and I wonder what that means for your view on Europe. Do you not see more catch-up opportunity for European equities from here?
Europe is a difficult one because Europe basically is the best region globally this year. And the best region at a time when we have seen a lot of things happening and most of them not positive. So you have seen basically a recession, ECB kind of not clear in a way in what they are doing. And still Europe has done very well. I think Europe, to be very optimistic on Europe, I think you need to see a real acceleration in growth. I suspect that you have to wait the second part of the year. And the reduction in cyclicals is mainly because of the performance that we have seen. We have seen commodity prices basically at 10-year high. We think that's probably has gone a little bit too far. And so we're not particularly bullish on Europe. But I have to say that I think there will be a good time to buy Europe, I think, more in the second part of the year when the European economy has fully reopened.
How do you hedge against inflation, Luca? I was talking to the Siemens CEO, Roland Busch, a little bit earlier, and he said they're passing prices on to customers. This is something we heard from BMW today as well, and many of the car makers. Those prices aren't likely to come back down, right? So this inflation is, at least for some products, here to stay.
Well, I think we have to keep in mind, though, there is also a base effect. So I think, this rise in inflation partly is temporary, but I agree with you that for some corporation or company, it would be difficult to pass over this increase in price. For others, it's easier. So the best way to hedge against this is to be focused on companies with very strong pricing power, And I think when you look at assets in general, I'm afraid there are not many ways to hedge against a significant rise in inflation. We know from past experience about equities and bonds suffering this environment. You can, of course, look at gold, but gold has been struggling recently. So probably the best way to hedge against inflation now is to be kind of overweight commodities. But again, you look at the market moves and it's probably too late. So it's very difficult to hedge against a rise in inflation at the current time.
Thank you so much, Luca Paolini, their chief strategist at Pictet Asset Management. Now, coming up, it's Jobs Day, in case you hadn't noticed, in the U.S. We'll take a look at what to expect from the figures next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz in New York with Francine Lacqua in London and Matt Miller in Berlin. Well, it's Jobs Day. Economists expect a sign today that fewer business restrictions are bringing more Americans back to work. The April jobs report is due out at 8:30 a.m. New York time. It's likely to show that the economy added about 1 million jobs last month. Joining us now is Michael McKee, Bloomberg International Economics and Policy Correspondent. Mike, it could be a strong number, but it is just one data point. And Jerome Powell has said he wants to see a quote-unquote string of jobs reports like March before he's confident in the recovery. Is March to April a string?
No, that's not going to be enough. And it's going to be interesting to see how the markets react to this. If we get a million jobs, they're expecting that we're not going to move too much. There is one forecast for 2 million jobs. So if we got that, maybe they would move a little bit. The question is, how much is too much for Wall Street before the Fed? Fed's going to wait as long as possible. They're looking at the total number of jobs out there, and we're still 8 to 10 million below that, even if we get 1 million today. So the Fed's not looking to do anything right now. It's going to be several months. So I'm not sure how you trade this in the interim.
So, Mike, what else are you looking at in terms of, if you look at some of the surprises that we could get, does it give us an indication of an overheating economy, or what are you looking for?
Well, it's hard to say we're overheating at this point because this is such an unusual situation where we are reopening. I'd say we got 1 million jobs returned rather than created during the month. The thing that we're going to be looking at first is service industry jobs, because that's the industry that was hit the hardest. This chart is kind of interesting because it shows you the magnitude of what we're talking about here. You look all the way over on the right-hand side and you see that's a forecast for 1 million jobs. Doesn't look like much, does it? You look back at last year in March, April, and May, and we had such enormous swings that it's hard to get a feel for what actually matters. We know that the average hourly earnings, for example, are going to fall, even though people are coming back to work, because it's the low-paid workers coming back, and they're going to pull down the overall numbers. So it's going to take a couple months, not only of strong job growth, but to work last year out of the system so we get a clearer picture of what's going on.
Why are low-paid workers coming back? They're still getting these unemployment benefits. When I talk to hotel operators or restaurant operators around the U.S., they always tell us, Paul Sweeney and I talk to a lot of them on our radio program at 1 p.m., shameless plug, that they can't get anyone to come to work because they're getting too much from unemployment benefits. I always say, why don't you just raise their wages? At some point, that has to happen, right? Or unemployment benefits just run out.
Yeah, unemployment benefits, the extended unemployment benefits run out in September. So at some point, people have a decision to make. The issue may be partly that people are getting more money in some states because some states are more generous. But it is also true that a lot of people's jobs aren't there anymore, especially if you were a bartender or a waitress or a bellman at a hotel that have closed. They don't have a place to go back to. So that's one issue. And what are they trained to do for other jobs? So it's a little bit harder to match up the labor supply with the openings that we have right now.
Well, yeah, to that point, Mike, we got NFIB data yesterday, a really good read on what small businesses are dealing with. 44% had job openings, 59% said they're trying to hire, almost a third of them raised compensation. There is a real labor shortage out there. Is that going to lead to more wage pressure? Is that being underestimated?
It's going to lead to more wage pressure, but it's probably going to be at the lower ends. These independent businesses may be offering more money, but they're not offering a lot more money. And the question then is, do we see that continue? In other words, if I raise my wages and Kailey comes to work for me, then do I have to raise her wages again? Only if she sees that prices are going up and comes back to me and says, I can't live with this inflation, I need more money. And the Fed's betting that's the part that's not going to happen.
Yeah, unless she gets a better offer, right? So the problem, Mike, is that if you're worried, if the economy is picking up and you have other offers, then that's another way why you would put people's wages up. Michael McKee there. I'm really looking forward to that jobs number and all of the analysis that Michael will have. Neil Kashkari also. That is definitely the interview of the day. Now, coming up after the U.S. jobs report, Mike in conversation with Minneapolis Fed President Neil Kashkari. That's at 8:30 a.m. in New York, 1:30 p.m. in London. And then a little bit later, we'll get the Biden administration's view on the U.S. jobs report with Marty Walsh, U.S. Labor Secretary. That's at 9:30 a.m. in New York, 2:30 p.m. in London. And this is Bloomberg. This is Bloomberg Surveillance, early edition. I'm Francine Lacqua in London, Matt Miller in Berlin, Kailey Leinz in New York. Now, we're also joined by Tom Keene, co-anchor of Bloomberg Surveillance, to talk about jobs. I know, Tom, it's one of your favorite days of the quarters, but also the shakeup now at Credit Suisse, which continues over Archegos.
You know, the moving of the deck chairs at Credit Suisse. What's fascinating about this really is indicative, Francine, of the moving of the deck chairs regionally that you see. And Asia's already had this feel. Neil Hulsey comes in to save the day. A couple years ago, people from Deutsche Bank went over to Credit Suisse, so the people from Credit Suisse didn't know where to go, so they went over to Deutsche Bank. And you get that's very fluid in Asia in terms of teams and trusted individuals moving around. Essentially, Credit Suisse takes the guy in Asia and helps them to solve the equity trading parts of what happened out of this family office disaster.
Right, and this is after Credit Suisse lost, everyone's aware of the story, but still a good reminder, lost $5.5 billion because of the collapse of Archegos capital, and one of the reasons is that they were just not quick enough maybe to sell some of the equities. But Tom, I think it just goes to the underlying question for banking is how much risk do you take? And now we're talking about a new overhaul, a new bank strategy, they have a new chairman. But is it just a bank that needs to be de-risked? And is that the path that it was over the last 5 years?
The theory is different than the greed. And the answer, Francine, witness what we saw this week about the amount of money they took in, given the amount of leverage and exposure the bank had, is it's amazing how much leverage you'll put on to bring in X amount of revenue generated in Zurich. I mean, the numbers still stun.
Yeah, they do, but then again, that depends on who's in charge, right? And at some point, somebody says, yes, we have risk appetite for this, or we don't. So that's the lens that we should be looking at is like, is this an overhaul of a bank that's needed, or is it more masking a more underlying question of actually, can we just afford that much risk for such a bank?
Yeah,
Tom, I'm looking forward to looking at your jobs analysis.
Yeah, we have Jobs Day. We're looking forward. It's just another boring Jobs Day. Snooze fest.
Yeah, the economy won't be overheating at all.
Yeah. I'm looking forward to, seriously, Mike McKee with Neil Kashkari after the jobs report will be interesting.
Yeah, Tom, thanks so much. Tom Keene there, co-anchor of Bloomberg Surveillance. Now, every Doge has its day, and this week it could be Saturday when the self-proclaimed Doge father, Elon Musk, hosts Saturday Night Live. Ahead of his appearance on the American comedy show, Dogecoin has staged a massive rally to become the fourth largest cryptocurrency. Well, joining us to make sense in all of this is Danny Berger. Danny, are we really at the point, first of all, I mean, this is probably my favorite hit of all time. Are we at the point where we can say that SNL is a market event? event.
We definitely are. Look, I don't know why we're talking about Jobs Day today. This is the market event that everybody is going to be looking towards and forward to. I mean, look, basically what's expected is Elon Musk is probably going to say some sort of joke about Dogecoin. There's going to be some skit. People are going to go in. They're going to buy it. But it really just encapsulates the world of meme investing. He's a great epitome of it. I mean, last month tweeting, calling himself the Doge father, promoting his SNL appearance. And look, it feels really silly to be talking about this. I mean, especially, after those great words from Tom Keene about a much more serious topic. But that's part of what's attractive here. The very fact it is a meme sort of thing is what gives it value, because it is fun to go in and to trade and to make money. And look, very serious market people have analysis about Dogecoin.
If $80 billion isn't serious, I don't know what we're doing here. I mean, that is 2 times Ford Motor Company's market cap. Thank you, Kailey, for that little factoid. It's a massive amount of money, and kids all over the country are into it. What does it mean, though, for the rest of cryptos? Because I noticed sometimes CRYP goes, where you can pull up all the cryptocurrencies on Bloomberg. We don't have Dogecoin on there. Maybe it's Tom Keene's fault. But even as other cryptos come down, sometimes we see Doge rally up to 69 cents.
But, okay, well, Matt, I think part of what's behind this is Doge doesn't take itself seriously. Not that it's, a living being, but Doge investors don't, despite the fact there's a lot of money behind it. But that sort of idea isn't really great for Bitcoin advocates, for Ethereum, because they want to be this serious store of value that has to do with limited supply.
Yeah, they hate it.
Those factors have nothing to do with why Dogecoin has been rallying. It doesn't have that supply thing. And so, that becomes a concern if you want to take other cryptos more seriously.
All right, Bloomberg's Danny Berger, thank you so much, guys. I am so excited for Saturday night. I almost am willing to put money down that Elon Musk is going to show up in a skit dressed as a Shiba Inu. I feel like that is something that isn't out of the realm of possibility, Matt.
I can't wait to see how he is. I have faith that Elon Musk is going to be very funny and quite good on SNL. Now, I could be proved wrong. I've never seen him act before. But he could be absolutely hilarious, and I'm willing to stay in. Well, actually, I am willing to wake up early on a Sunday morning, because it's going to be 5:30 a.m. here to see Elon Musk star on SNL.
Right, except he's been so unpredictable. Maybe he shows up and wants to talk about the U.S. jobs report that we saw today. There you go, anew on SNL.
You can't rule anything out.
Overheating, of the economy and inflation forecast by Elon Musk. I'm also looking forward to it. I don't know whether Danny's waking up or staying up late. Well, not for the moment, but at some point maybe it could.
Okay.
Elon Musk on Clubhouse talking about overheating with Putin. I don't know. We're making no sense, but this is kind of where a lot of these memes are going. Coming up next, Randy Krosner, University of Chicago professor and former Federal Reserve Bank governor. This is Bloomberg.